Present.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx. International President Teamsters.
Here.
Transport Workers Union.
Good morning.
District Council 37.
Here.
Sandra, did you want to make an introduction?
Yes. Good morning, everyone.
Good morning.
I just wanted to introduce Pooja Bansal, our counsel for our president's office. She's replacing Jason as our counsel, and she will also be, my alternate.
Larry, over here.
Okay. Just by way of background, I have an inner ear infection. I cannot hear out of my right ear. So whatever you all say down there, sorry, can't hear you.
Say anything we want.
We can say terrible things.
So if I talk too loud or too low, you have to tell me because I can't hear how loud I'm talking. So, that.
All treatable, Larry?
Sorry?
All treatable and...
Any minute it's supposed to open up, but I don't know. It's now been 2 weeks and I can't hear a damn thing, so it's a little annoying. But, let's go. Does everybody have one of these? I'm not going to walk through all the charts. Let me see if I can give you some summary of what's going on. These are the main numbers. And again, the fiscal year ended. We'll get to that in a moment. But the bottom line is that the crisis in Europe, whether it's the banks or the sovereign crisis or the euro or the EU, it's basically overwhelmed anything that looks like the markets. So when it flames up like a bad infection, everybody runs to risk. There's some meeting, a little ointment gets put on the infection, and everybody calms down. But the bottom line is it's not fixable in a meeting. It's going to take, anyone's guess, could be 2, 3, 4 years to literally fix it. And people are starting to deal with that from an investment perspective as to what that means. But it means lots of volatility, lots of ups and downs, risk on, risk off. It's a good time to be a long-term investor on one hand. On the other hand, it's a very bad time to be a long-term investor because you could be perfectly set up and all of a sudden the markets fall apart. So nimbleness is important. As you know, we've moved some money into opportunistic fixed income, which is a good thing because they're nimble, much more nimble than we are. So the big news in May, if you go back, actually the big news in May was sort of held over from probably March and April, which was in March the French elected a new president. The French were the right-handed compatriots of the Germans. New players showed up with a different agenda. The Greeks had in a first round of an election that basically had as a contender in the runoff the socialists, which wanted to basically abrogate the deal that the Greeks had made with the EU and IMF. So the markets went crazy basically in May with the uncertainty as to what the Greeks were going to do. Ultimately, they elected the more centrist person, which is still going to renegotiate the deal, but in a more constructive manner, let's say. So the markets reacted well in June. But May is bad, so we'll show you some bad numbers in May. And what's slowly starting to happen is I think people are slowly losing faith in the euro. So you can see that in the exchange rate of the euro. If you went back a year, the euro was in excess of $1.40, $1.40 each. It's about 120 now. So if you do the math, that's 15, 20%. That's starting to add up to a lot. Now, on the other hand, I would tell you it's a good thing. A weaker euro is good for their manufacturing, so there's a certain amount of they're doing what they're supposed to do. But again, it's volatile. If you come back to what's happening in the United States, I don't have to tell this room, unemployment is going back up. The economy is slowing. You've had 3 months of slowing retail sales growth, the first time that's happened in a long time. You have the presidential election coming up, so politics is reigning supreme. You have the expiration of the Bush tax cuts, and you have the fiscal cliff. So you have uncertainty in Europe, which goes up and down. You have uncertainty in the United States. You have things kind of sliding back into a recession. You have the Fed trying to do things. You have no fiscal policy. And you have China slowly slowing down because things are manufactured in China and they have their own issues. All that is kind of not a very good backdrop for investing. So basically, things are kind of going down. People are trying to make money. Very, very difficult to make money. And every now and then you get this, what I'll call, flame up happening. And in the middle of that, you get the occasional scandal. You might get some headline grabber like the whale and JP Morgan, which isn't really a scandal, it's just a mistake. Or you get something like LIBOR, which is a humongous scandal, which will take years to figure out. We'll get to that perhaps a little later. So the easiest way to see what went on in May is to jump to page 41. And remember, May was what I'll call a flare-up crisis. The crisis was the Greek election. That was the crisis du jour. So in May, you had the U.S. equity markets, which again, if you look on the first column on the left side, the top block are the U.S. equity markets, down 6.5%. The next block are the international markets, EFA emerging markets, down 11.5% to 13%. So that's all in a month. That's pretty dramatic stuff. The flight to quality means that treasuries go up. So again, what you've had going on is every time it's a flight to quality, and you have slowly but surely the Europeans saying, I don't think we like the euro, they move into either bunds, which have a negative return now, or U.S. Treasuries. So Treasury yields has been going down, down, down. Now they're hitting a new low yesterday, the day before, 1.41% for 10 years, which is an absurdly low interest rate. Part of it is the Fed keeping rates down, but it's not the Fed anymore. It's just people looking for safety. Having said that, had a nice meeting in Europe. Things came back, and that gets you to the next page, on page 42, which is June. And a lot of June happened on the last day of June. To show you how bizarre and how micro. Again, we're long-term investors, but these are all up. They had an announcement literally on the 29th of June. There was one day in June. They had an announcement on the 28th. The 29th was the last day of our fiscal year. The markets were up 2+% that one day, so the whole month turned out to be positive for the month. So if we look at the next page, page 43, this is the month of May. Again, on the far left-hand side, we lost about 4% in May, bringing the third column, our fiscal year results, to down a little more than 1%. When you add it all back together, with the rally in June, the city was up about 1.7%, went from 119.9 to 122 billion, unaudited preliminary numbers. NYCERS went up to probably up between 1 and 2% for the year, probably up somewhere between 41 and 42 billion, which is pretty much back where it started the year. It was positive. It was positive because NYCERS pays out about $1.2 billion of benefits during the year. So to end up in the same place, plus or minus, is net of $1.2 billion worth of payout. If you look at how the assets are set up, the asset allocation page, which is the pie chart is the easiest, which is back on page 37. We're pretty much inside the bands. Between May and the end of June, we lightened up on U.S. equities again. So we sold another 1%. We lightened up some more on EFA. We added to Core Plus 5, and we had we funded one of our hedge fund managers. So we kind of end up the year at about 67.5% equities, 32.5% fixed income, which is well within the bands. And that's sort of the end of the year. That's a little bit of May, which is this book, moving into June, giving you an estimate as to where the fiscal year ended up. Again, the city's 1.7% compares to CalPERS 1%, compares to CalSTRS 1.8%. So it's not that the public pension funds do poorly, if you will. I mean, it's not the 7 or 8% the public pension funds are shooting for on a long-term basis, but it's basically the markets, right? All these people are trying as hard as they can, but when you have these kind of markets, they get overwhelmed by news events. Put 12 months together, that sort of gets you not very far. Anyway,
Gary, do those numbers include estimates for private equity and real estate, and what did you guys use for that, for the 1 year and June 30th?
yes. They do include estimates. We called two-thirds of the managers?
Yes.
We called two-thirds of the managers and said, we need an estimate as to what you think the marks are going to be. Which, of course, they won't have the marks for 45 to 60 days, and we wouldn't ordinarily put them in till later. But we called for estimates. Private equity was up for the quarter.
Private equity, the quarter was up, and the band against the exact numbers, call it in the kind of 3 to 4.5%.
And real estate was up. I can't hear you. About the same.
So with equities down 3 to 4%, private equity and real estate, which total about 10, was up 3 to 4%. That's a huge part of the results for us. Is that for the quarter? Is that fair?
Yeah. Hedge funds were probably break even,
Yeah.
up a little
Up a little.
for the quarter. So the hedge funds kind of did what they were supposed to do. There wasn't as much volatility as those stock market things would show you. They were less volatile, but it's still small. The opportunity fixed income took a little money, but too soon to tell. The Core Plus 5 made money, and high yield did okay. So it was a little this, little that. Nothing fell off the cliff, and nothing was a home run, pretty much. So that's the review of May and a glimpse into June, and we'll get back again in September. We'll walk you through the year in review and where we stand. Any questions? Perfect. So today, where is Susan? Catherine, sorry. So we're going to get Alan. So the Controller's Office and the Bureau of Asset Management engaged a company called CEM Benchmarking to compare our 5-year cost numbers with other public pension funds. And one of the partners, Alan Torrance, that we've been working with, it's been a very, very laborious task because we've basically given him every cost number for every asset class for the last 5 years, which is a lot of numbers. I'll let Alan explain the process and what the conclusion. This is Alan Torrance. But again, this is the CEM. Can you give a little, Alan? Can you give a little commercial for what your firm does? I don't want to steal your thunder. I don't want to sell you short, but tell us what you do before you go into the whole presentation.
And how you do it. Okay, thank you very much, and thank you for inviting CEM Benchmarking to the board meeting today. CEM Benchmarking is a private company in Toronto, Canada. There are 22 of us. We're not a very big company. Our business is around benchmarking for pension funds and benchmarking costs for pension funds. That's all we do. We don't consult. We're not paid by the hour consultants. We run an annual survey on the administration side that looks at administration costs against administration services, and on the investment side for defined benefit plans and for defined contribution plans, looking at the costs of running the plan and what are you getting for those costs. It was started back in 92. Excuse me. It was started back in 92 by people who had an idea that people who had written books about pension funds had an idea that pension funds should be looking more at their costs and their return rather than just their return. Because what matters at the end of the day is the net return to the members, not the gross return, the net return to the members. And so from that we've put together a database over the last 20 years. And as you can see from page 1, now I'm going to refer to page 66. This is the defined benefit database that we have. We also have an administration database and a defined contribution database. Today we're focusing on the defined benefit database. You can see that each year around 200 American funds participate in our survey. Of those, we have a number of clients who we provide a detailed report and a presentation like this to each year. The larger funds tend to be our clients. We tend to be part of their annual process, fiduciary review, performance review, and cost review, and it helps them fulfill their goals in terms of monitoring their costs and understanding their costs better. We are growing around the world, but I won't spend too much time on that. This morning we want to talk about the combined fund of the New York retirement systems, which is what we did this survey on in 2010. If we look at page 67.
Everybody has a separate handout.
Oh, okay, I'm sorry. Page 2 then, good. That will make it easy for me, thank you. This is just a breakout of the universe, as we call it, the database. You can see that New York Retirement System, we have collected data for some time. Casting your eyes down to the breakout of the US funds on the left-hand side, you can see that we have around 120 corporate funds in the database and 69 public sector funds in the database. But if you look at the total and the average, or if you want to cast your eyes to the top, at the pie chart at the top, you can see that the US public sector funds, 69 of them, dominate the database in terms of assets under management. We'll talk to the peer group now on page 3. So what we want to do with the information that we have gathered, or what we do for our clients with the information that we have gathered, is to look at this fund, and we're going to do some cost attribution and cost analysis for you today, and look at the messages that come out of that. In order to do it as best we can, we look at a peer group as well as the universe. So when we're talking to Larry and Catherine about the peer group, it was requested to CEM that we look at 18 to 20 sponsors from North America, from both Canada and the United States, and that's what we've run it against for the purposes of today's presentation. As you can see, there are 6 Canadian and 12 US. Our goal in putting the peer group together is to come up with a median size of a peer group as close as we can to the size of the combined fund. What we're trying to do there is get a mimic, if we can, of the buying power of the fund. We don't want small funds in there. We want funds with similar buying power. So when they're negotiating with managers or making decisions on how they're going to implement their assets, those decisions are similar and they have similar options. And as you can see, we have a median size of 80.5 billion versus 113 billion as it was in the calendar year 2010, and that's the analysis that we're looking at.
The 12 U.S. funds, are they all public?
Yes, they are. They are. Let's take a bit of a look at the peer group and looking at asset allocation on page 4. This just gives a bit of a snapshot, and because we have the Canadian funds in there, we're not going to delve into what sub-asset classes like Canadian equity or US breakout. We're just going to look at for the purposes today, the total equity or total stock and total fixed income. And the story that really comes out of this, because this is the policy mix asset allocation, not actual mix. What comes out of this, I think, is that your fund in 2010 had 62% equity, and funds of your size had 48%. Now, the US average, or the rest of the universe, in other words, the 200 funds we have in the database, had around 50% equity. In terms of bonds, you're around the same. Total fixed income, 30% for your fund, 34% for some of the smaller funds, 29% for the peers. So what it's showing is that you're higher in equity. So where the other large funds are investing rather than equity is in the bottom 3 categories, or in the alternatives or non-public assets. And that's where they're in real assets, and by real assets we mean real estate, REITs, commodities and natural resources. The peer group's up to 12% in those sorts of assets, compared to 3% for the combined fund. In terms of hedge funds, they were 2%. In terms of private equity, 9%. So the combined effect of the non-public assets there means we can infer definitely that funds of your size are more heavily invested in those assets than yourselves.
I made a point, Mark, I think you'd agree with me, that is not so obvious on this page, is the long bonds. And over the time period that we're about to look at over the 5 years, long bonds have been easily one of the best performing asset classes, up 20-30% on an annualized basis practically. I don't have the exact numbers, I just remember it. And so I just think in terms of thinking about asset allocation, it isn't just the equity weight, it's also the fact that our bonds weren't as long as our peer, as the U.S. average, for example.
Absolutely. I guess my approach here is from a cost perspective.
Right.
And from a cost perspective, that's why I'm grouping it into equities, and there's different between emerging market and U.S. equities from a cost perspective, but not to the same extent as equities to bonds to alternatives. Alternatives are a lot more expensive, as we'll see as we go through the analysis. I got some numbers for that. A lot more expensive than
Sure.
equities and bonds. So your point is correct. I'm just approaching it from a cost perspective.
Sure.
Roger, although your point, I think, was that you think that your peers may have more long bonds than even than this. I guess I'm not sure that's the case. I would agree on the corporate
More than
side.
this, but just more than us.
Well, they have 3 versus...
Or, not the peer, doesn't get the U.S. average.
But the U.S. average, I would assume, includes corporates.
Absolutely.
And there is where the long bonds are prevalent, because in fact they've instituted LDI. I think in public funds, the 3% is probably more of an accurate weight. So the difference relative to your peers is probably small. The difference relative to U.S. is larger because the U.S. includes corporate funds who adopt LDI.
Sure, good point.
Yeah, I just want to be clear. On this page, are we talking about the 12 U.S. funds, or are we talking about the large universe on because peers?
Under the heading U.S. average, in the middle column on the right-hand side, that is the 200 United States funds. The peer group is the 18 funds, which includes 6 Canadian. Okay, and that's why I focused on total equity. So when we're talking the peer group, and we're going to look at that a lot, it does include the Canadians as well. Correct. Yes.
So there are no university endowments in any of these?
There would be some in the 200 in the U.S. universe. We don't have a lot of endowments actually in our peer group. It's one of the areas we're lacking a lot. We don't have a Yale or a Harvard in there at the moment.
Mark, I don't want to steal your thunder or go where you're going to go later, but from this page, is there some conclusions we can draw? Look at the next page, it's not clear. Are there cost conclusions from this page?
I'm going to take you through it step by step in detail, and probably too much detail, so I'll come back and summarize at the end. But yes, there are definitely conclusions. One of the conclusions, just a headline, is that this is a cost analysis, and your costs, the more alternative assets you're in, the higher your costs are going to be. And we're going to see that. The other thing is that's going to have a return effect as well. Because asset allocation, policy asset allocation will determine return. And in fact, that leads nicely to the next page. If policy determines return, and this is a cost analysis, what we're after is really what are you spending and what are you getting? Because you can get market return relatively cheaply, or you can spend a lot of money trying to get alpha and high risk adjusted returns. On the next page we look at value added, and just a quick look back from 2010, 5 years, at the value added that the universe is represented by the box in Western. The peer median is represented by the green dash, and the red dot is the combined assets of New York retirement systems. And this is value added, so this is the actual return minus the policy return over that period. And to keep it reasonably high level, the total in the middle of the box on the left-hand side gives you the 5-year total value added number, and it rounds to 0. So what we're looking at is what you're spending over and above what you could be spending has given you a value added of 0 over that period. That compares to the peers. If you look at the green dash, if you can see it, it's right on the median. That's a little bit above 0. So your peers, the other large funds, including the Canadians in that group, are adding a little more value added over this time period than yourselves. Where are they adding? If you turn to page 6, you can see that your equity value added over this period has come in close to the US average. Fixed income has not. Now I just want to jump in here and say that you will have more up-to-date and better performance measurement figures from your performance measurement provider. All I'm trying to do here is set the tone, or set the background for the cost analysis we're about to do. So what we're looking at is saying, if you're paying more than your peers, are you getting more? Well, in terms of total value added over 5 years, no, you're not. So let's now take a look at cost and understand that. CEM runs an annual survey. Actually, we run several across our different products, but for the defined benefit, we run an annual survey, and we collected your cost information in 2010. And we collected it in certain buckets. The first breakout is fairly obvious. It's a passive-active split. Passive is a lot cheaper than active, so we want to put those in 2 different buckets. The other breakout that we have is for funds of your size especially, what's being managed internally and what's being managed externally. So what are you giving to external asset managers? And what are some of the large funds doing by employing their own staff, setting up their own shop, and doing it themselves? And that, of course, gives us a double breakout of you can manage passively or actively internally, and you can manage passively or actively externally by hiring external managers. We capture all your costs for the 2010 year, and they came to 419 million. We also capture costs such as oversight, custody, and all costs related to investing. Trustee and custodial consulting and performance measurement. Just a quick word on consulting. If consulting is done at the asset class level, it becomes part of the investment management costs. Consulting there we're talking about is at the total fund level, asset liability or studies like that. So your costs, as were reported to CEM and verified as we could by CEM, came to 39.2 basis points. Over time, turning to page 8, your costs have increased. Now, I will show you charts in the research pages at the end that will look a lot like this. This is not an unusual chart. As large funds especially have moved into more private assets, hedge funds, costs have increased. To get the diversification and the return and the risk, all that goes with moving into those asset classes, they cost more. And we'll take a look at those costs. So, of course, you can see that through 2 of the lines, left to right, haven't moved that much, and the private assets and hedge funds has increased, and that's increased the total cost. There are, of course, benefits to that you've discussed at other times. What we're going to do now is take a look at yourselves against the peer group in terms of cost. And on page 9, we're going to benchmark your cost. The way CEM does this is to look at the peer group and take the asset allocation out of the picture. Now, you will have policy weights different to your peer group. We've already seen those. What we're going to do now is give the peers your policy weights, but use the the peer group costs and do a weighted average to come up with what we call a benchmark cost. That cost, in simple language, is what we would expect a fund of your size, public, US, given your asset allocation, to be spending. And it comes up with 39.3 basis points. Comparing that to your actual cost on page 10, we can see that it comes in very closely to your actual cost. And at first sight, that's very satisfactory. Of course, what we're going to do now is break it out and look at the undercurrents of what's actually happening. On page 11, we do that. There are two buckets that we can break that out to. To explain that the difference between you and your peers, we can look at, first of all, how are you investing? And second of all, given that you're investing that way, what are you paying compared to your peers? So the first we call implementation style. You've decided, for example, to go into private equity. But how are you going into private equity? Are you using a fund-to-fund? Are you going directly? Are you working with other funds directly? There are different ways to do it, and they all have different costs. Your implementation style is costing you around 4.5 basis points or 47 million. We'll break it out a little more. The second is paying less than your peers. So given that you've gone primarily external management, we'll see that in a minute, you're paying less for that external management than your peers. So let's break these buckets out and get a better understanding of them. One of the major points that comes out of this presentation or the analysis to me, and I think anybody who reads it, is that your implementation style for a fund of your size is very different to your peer group. And we can see that on page 12. If we group the bottom two together and just call it external, whether it's passive or active, the New York retirement systems are 97% external. So you're giving all your funds management, investment management, to people outside the fund to run it. If you look at funds of your size, the peer group, around 53% is done internally by funds of your size. That's the 6 Canadian, the 12 US. If you look at the US funds, where we drop to 200 funds, but they're smaller on average, not nearly as much as being done internally. So the observation there is that large funds, the 18 that were selected to best fit, are doing 53% internal management and the remainder externally, whereas the New York retirement systems are doing them nearly all externally. And in fact, the 3% internal is just a little bit of cash and bonds, I believe. So
within the 18, I assume there's a range of internal and external.
not as much as you would think. If we, there is a little bit.
Okay.
Yeah. The 6 Canadians tend to do a little bit more, but the U.S. publics that are in this are in and around that number as well.
Okay.
So the distribution's not that high.
Mark, just to put that in perspective, New York State teachers and New York State economics will be more than half and half.
Right, yeah. I'm familiar with teachers.
The other thing we should look at very quickly with implementation style is the breakout of fund of funds. When you're looking at hedge funds, real estate, and private equity, using fund of funds is a very expensive implementation style. You're paying for someone to select managers for you, so you're paying twice, if you like. And we make sure in our database that we collect both levels of cost as best we can. In terms of newsworthy for this table, 7% of your private assets are through fund of funds compared to 4% for your peers. That's not a huge number, but just to again make the point that fund of funds are more expensive, and there's data at the back of the presentation to support that. I'd just like to share a few pages on implementation style, really just to reinforce the point and break it out a little. On page 14, again, you can see your fund, and then we break it out to U.S. corporate, U.S. public, of which there are 60 or so funds, U.S. other and all U.S. funds, and then back to your peer group. And you can see that the larger funds, which are your peers, again, are up around 52% internal. The smaller U.S. public, again, not so much internal. And in case you think that's a 2010 blemish, it's not. We always like to look at some trend analysis, and you can see that the trends in your implementation style have not changed. Your external, we break it into passive and active, but really it's external, internal. The picture has not changed too much, although the mix between passive and active has changed a little. And then on the next page, page 16, we break out over time the peers, and you can see that hasn't changed a lot, and the universe itself, so the 200 US funds, and you can see the difference there. The summary of this is that big funds use internal management and use it quite a lot, setting up their own shop to the tune of 50%, based on the peer group that was used in this report. What we do on page 17, without scaring everybody off, there are a lot of numbers on page 17, is we actually quantify that through our model. What we're saying on this page is that we're going to look at external active. If we look at, there are three other options: to do it internally, either passively or actively, or to do it externally, passively. Those three options are a lot less expensive than external active management. Going out to an external manager is an expensive option, expensive way to do it. So what we're looking at here is, for each asset class, we're calculating what it costs you in dollars for that allocation decision or implementation decision. Looking at the top line, there's $37 billion in US stock broad oil, of which the New York retirement systems are putting most of that into passive, so it's not in external active. That compares to a peer average of 15.1%. So the peer group is has 15.1% of their US stock broad oil in external active management. We calculate a cost premium. The cost premium, very quickly, is just the difference between the cost of external active management and the other three options. So the decision by New York retirement systems not to use external active management for its US stock broad oil, that large pot of $37 billion, is saving you $24 million in fees. Of course, it has to be compared to risk and return, etc. This is a cost analysis. Looking down the page, that's the only saving, really. The rest are expenses, costs. $13 million in terms of US stock large cap, $20 million in terms of EFI. So let me just take you through the EFI again. You're investing close to $15 billion in EFI, but you're putting around 90% of your EFI portfolio through external active management, which is expensive, compared to around 48% of your peers. So it gives you a good feel of how much the system is using external active management compared to the peer group. Even if you don't want to look at the columns on the right-hand side and quantify it, if you just look at how much your fund is using external active management, you see a lot of 100% there compared to peer averages, and it varies quite a bit. But again, the peers are not using external active management as much as yourselves, and we've already seen that they're using internal more.
Pardon me, Frank.
Sure.
Question I asked already.
Who are our peers?
The peers were on page, we can't tell you the actual names of the peers.
That's okay.
It was the 18 sponsors on page 3. 86 Canadian, 12 US, with a median size assets of 80.5 billion. All this cost attribution is done against the peers, not against the universe, because we're looking at funds with similar buying power and similar options in terms of implementation style. Small funds of $2 billion cannot invest in the wide range of things that large funds can. They can't set up an internal operation. Large funds can set up an internal operation. They need to go fund to fund sometimes because they can't go direct. They don't have the money to go direct if you only have $2 billion. Whereas if you're a large fund, you have more options and more choices.
The costs, were they, the cost that you showed here on page 17, cost premium, is that normalized for CPI and wherever that?
No. That is looking at the median of the peer group costs for each asset class. And then there are three options there. So passive, or you can do it internally, or you can do it passively externally. And we're grouping that together and then comparing it to the median cost of the external active. So if you look at the US stock broad, there's 44 basis points difference between going external active and the other options.
Right.
And we'll get through. I've got some numbers in the last page that'll make that pretty obvious.
I'm sorry, did you understand my question? I was trying to see if it was, if these cost premiums were specific, were normalized for what it would actually cost us to go out and hire the same kind of staff in New York. In other words, I'm assuming it would cost less to
I get you.
hire staff in Des Moines.
Correct.
Versus New York.
No, they're not. I understand your question. You're talking about the internal management piece?
Yes.
And no, the internal management piece is purely dollars. So you're right. It would be slightly more expensive, and you come with making that decision, I guess, to understand what expense you need to and where you want to set that up, et cetera, et cetera. Moving on to the next page, we now look at the three options of doing it internally, and doing it externally, and doing it passively. So you can do it internally. When you do it internally, you can choose between active and passive, and the external passive. And the numbers on this page aren't headlines, so I'm not going to dwell on it too long, other than to say you had an external passive US stock broad all of 37 billion. That's the number that dominates this page, and that compares favorably, and we'll look at the numbers later, that your external passive is actually very, very inexpensive, even compared to others who are doing it internally and actively. So there's a saving there. But it's not a headline. If we can move to the next page. What we just looked at was just to sort of rise above it and go back to what we were talking about. There were two buckets. The first bucket was how are you doing it? What's your implementation style compared to the others? What we're looking at here is the next bucket, which is, okay, given what you're doing, which is external active management, how do you compare to your peer group? And if you look at this page, line by line, you can see that these are all savings. So you're negotiating, if that's the right word, your external investment management a lot better than your peers. And these are funds of similar size.
Yeah, this is my favorite page of the entire presentation. And for the 22 years I've been coming to investment meetings, the one thing that has been true about this board and the Bureau of Asset Management has been the pressure placed on external managers to deliver value. And it starts with the negotiating the contracts for the least possible fees. And it's nice to see some numbers on it after all these years.
So the cost savings is 5256, that's, so what is the minus 5256? I'm sorry, I'm on page 18.
Page 19.
Oh, okay, sorry.
So just to run you through that again, if we choose a large number, and let's choose fixed income US active halfway down, your average holding in millions, well, it comes to 18.7 billion you have invested in that. Your cost in basis points for that external active management, 7.7 basis points. The peer group of 18 peers is 17.5 basis points. So you're paying a lot less than them, because 10 basis points less. And that's a saving of around $80 million a year in terms of fees. The next page is one I'm just going to skip over. It measures the impact of internal investment management. The overall effect is 578,000. So what we're after are the bigger pictures. We'll move on. The last page is all those costs associated with investing. So there are actually investment decision costs, and then there's the support factor. And the support factor is BAM, among, is that the right way to put that? The Bureau of Asset Management, sorry. Amongst other things. And that comes in under oversight. Now, CEM's line on oversight is that this is the one cost that should not be minimized. Each fund should find its own level of oversight and spend the right amount with its understanding of compliance, its rules and local rules and regulations, and its risk tolerance and return tolerance. Each board needs to find their own level of oversight and spend an appropriate amount of money. What I'm saying in summary is too little spending on oversight is not a good thing. You could spend too little on oversight.
Oversight is the Bureau of Asset Management. Just so clear what
Right. And for example, if you just hired external managers and didn't monitor them, you would not have enough oversight. If you hired external managers and spent just as much again monitoring the managers, why are you doing external managers? But they're just extreme examples. In terms of custody, consulting, performance measurement, audit, all coming in around ballpark, and no real headlines there. So let me summarize. We've compared you to a peer group of 18 peers around the same size and same buying power. We've run a benchmark cost, taken the asset allocation out of the way, and said if all the peers had an asset allocation to match yours, the total cost would be about the same as your actual cost. But let's have a look at what the differences are. The differences are summarized on page 22. The biggest number on page 22, in fact, we have two flows going different ways and kind of cancelling out, but not quite. The biggest number is the 56 million number, and that comes from the fact that you're using external active management more than your peers. Most of the funds your size are using around or investing through internal management. They're running their own shop to about 50% of their investment management. You're not. You're choosing to go external management. That's more expensive and it's costing you. However, as you can see under point 2, the 39 million, given that you're doing external active management, you've negotiated some very good fees there, and so you're saving a little bit on the fact that you're going external. Any questions?
Clarify that, just so I understand the source of those two numbers between the internal and external, between us and our peers. Because it's not clear to me whether it's the public markets that are internally managed by our peers or the private markets that are internally managed by our peers. it seems to me that we today, just based on our allocation, have a lot more external active in the public markets.
Correct.
And so we've negotiated lower fees, but it's all been in the public markets. In the private markets, just based on that last chart that you showed us on page 17, we are at a cost premium. Even don't look at the dollars, just look at the cost premium. We are at, those are the highest cost premium numbers on the page, which makes sense. We have fund of funds, and we have external management. It's hard to negotiate a lot of fee breaks from private equity and hedge funds, even though we really try.
Correct.
So there's a little bit of, there's a chart, almost a chart missing, which doesn't allocate the savings between public and private markets. Can you just comment on that?
Well, I think I'd like to steer you, I guess, to page 31 and just look at the raw data if we can. Obviously, for each fund, the asset allocation, in other words, the weighting that you put into each asset allocation is going to change the cost difference. So you are very much in public markets, and therefore that's going to have a certain effect. Your peer group is more into alternatives, that's going to have an effect. But if you want to just look at the actual raw data of your costs or the peer median, and look at the differences between the internal active, if you look under the peer median side, so the right-hand side, the second column across is internal active. And let's choose, say, diversified private equity.
Or even real estate, just above it.
Or even real estate, sure.
So the external active for real estate is 95, and for private equity is 166, which is what we pay. And the internal active is 21 and 38. This is my point. And what was hidden in the prior numbers was the fact, particularly when you throw in the Canadians, which are a third of our peer group, that where they're getting their massive savings relative to us is a very different model for the private piece. And if you look at our allocation, we are at 8%, peer median is 23%, and we are headed there. So if I were to, look forward, some of our advantages in terms of being able to negotiate fees is not going to be an advantage. We're just going to pay our 39.5 basis points is very misleading, because if you go back to page 8, the public assets, we've been paying 13 to 14 basis points for a long time. The private assets have gone from 5 to 24. And that's as we've taken our allocation up to a mere 8%, and we're on our way to 20. So just if you extrapolate this, without the shift in Dan's model, our 39.5 basis points is going to soar, even with our ability to negotiate. Because it's just a limited negotiating power in this.
If you choose to do it externally.
If we keep our current model.
Exactly. Just
I think one step further, Roger. You're about to go from indexed equities on the margin to 10% moving to 1.5 and 20% carry. Right? So just put some numbers around that. That's a humongous shift, but it is coming because we've all approved an asset allocation that adds 10% into alternatives, with 10% being in NYCERS, it's 4% to hedge funds, it's 0. It's 1 or 2% in private equity. It's 1 to 5% in opportunistic fixed income, and it's an extra 1% in real estate. All those are expensive asset management, and it's all being funded out of basically passive equities, a little bit of active equities, but pretty much active equities. So our costs, particularly when you do it on basis points, to your point, we're going to take that curve that, I forgot what page it was on, and keep it going without mitigating any of it. So
and our value added over this time period has been zero.
Right.
You just have to stop and really have a conversation about this. This is fascinating data, but the trends don't look good.
No, the trends are unavoidable. We've said
Well,
about.
I think they're avoidable
See,
if
we've
you
said
change
about.
your model.
Well, if you change the model, but if you just leave it the way it is, our
But
cost is
now,
about to go
all we're
through
going
the
to do
roof.
is pay for fees again. Each year, just take this. We haven't added any value, and our fees keep going up, and we're preferring the asset classes where we are not able to negotiate fees down as much as we are in the public markets. So,
You're finishing your story for you, Mark, then you go.
They're doing a good job. If you look at the differences, and it is on page 31, just to reinforce the point, the differences between doing bonds, or funds of your size who can choose to do things internally or externally. If you can bring a team in and manage bonds and do it internally from the peer medians, you can save 6, 7, 8 basis points. If you bring equities in-house, you can save a fair bit more. If you bring private equity in-house, such as some of the Canadians have in this peer group, the saving is 130, 140 basis points. Of course, you have to look at the total dollar, and to your point, that means you have to look at your asset allocation to those asset classes as well. But the savings by each asset class vary, and the more alternative, the better you go. But if you do it through fund of funds, again, that's even more expensive. So.
but that is exactly why people bring fixed income in first, because on 25%, savings and basis points is not.
And there's a lot more to it than obviously setting up, getting the expertise to run bonds and getting the expertise to run private equity.
Very good.
There's a lot of issues there, I'll leave that.
Pat and then Al.
Understanding the cost comparison, what about the performance of the funds? And are they very interested in that? Because although you cannot tell us what funds are colleges, we heard earlier that CalPERS in the previous year earned 1%, and I'm making an assumption that they do things internally, and that CalStreams did 1.8, which is relatively what you did. So performance becomes a very key factor.
I thank you very much for the question, because we have some research in the slides to follow, and I can bring out some of that. I cannot tell you individual funds, but we can look at the 20 years of research that CEM has and run some regressions and bring some conclusions, which is what follows in this, if you'll allow me to continue with the presentation.
Al, did you have another question? Anyway.
No, in terms of the private equity internal cost, now that's an average number, and are there any outliers from the area?
There are a couple of things I should say, and thanks as well. In terms of gathering data that CEM does throughout the world on alternative assets, there are a number of stumbling blocks in the industry, if you like. We try our best, but unless we get the clean data, we can't do it. One of those things is around the cost of carry. In other words, performance fees in and around alternative assets. So we ask for performance fees accrued within a year so that we can put it into the analysis and use it. Not enough funds, especially in and around private equity or hedge fund funds, for example, can provide those numbers. Because what they're getting back from their managers, we hear, is net returns, and not all the fees are actually exposed. And sometimes it's through a confidentiality agreement, sometimes it's through not wanting to upset their manager, sometimes they just don't provide that information to us because it's too much hard work. So when we did that analysis a minute ago, it did not include cost to carry performance fees for alternative assets. For public assets, we do, because it's cleaner and more straightforward. So it is a kind of a chink in the armor of the analysis. We have to account for that. We're working with 26 of the top funds this year through a Global Leaders Program that CEM has to try and work with them as the first step to get accurate data and accurate performance fees, and then hopefully that will spread throughout the industry. We'll have to see how that goes. So,
But just order of magnitude, if the base fee difference is about 100, with the carry, if you were managing internally, Gary, would you agree it would extend to the hundreds of basis points?
Yeah, let's back up a second, because when you say the word private equity, that's too big a word, okay? So let's take the facets of private equity and look at them piece by piece, because embedded in this number is one thing of 4 or 5 different types of private equity. So the first type of private equity is a fund of funds, right? So that's the most expensive way, right? It's extra layer fees. If we have fund of funds, that's in here. The bigger guys avoid fund of funds. The second piece of private equity are secondary funds, right? So it's a manager who buys. So some of the bigger guys buy secondaries themselves and avoid a layer of fees. The next piece of private equity is co-investing. So some of the bigger guys co-invest with their GPs. The PhD course that the Canadians do is they buy businesses themselves. We shouldn't go there. Yeah, it is the PhD course. We're still trying to get to the 101 level course. There, they literally have a staff. They have 20 people. They buy businesses, and that is the PhD level course, and that's what drives these numbers down, in my opinion. I'm sure when we look, if you unbundle it, you get to that. That said, to your question, when you look at private, forget fund of funds, secondaries, and co-investing, the basic business of private equity costs 600 basis points, plus or minus, between the 1.5% management fee and the 20% carry. That's what the Canadians save by doing it themselves, is 600 basis points. The carry's not in here. It's a problem of the industry, I would tell you, that people don't keep track of the carry. We are keeping track of the carry. It's not in these numbers because he doesn't have the data to go with the comps. But it's quite fascinating to me that as an industry, public pension funds don't run it through their P&L. It's net. It comes net. So our $400 million, $419 million that we pay excludes real estate carry and private equity carry. So they obviously pay some more. And again, I wouldn't say it's off the books. It gets reported as net, but it does not run through the city's financials. Nor does it run through any other public funds financials. So it's not that we're an anomaly.
Yourself, you book.
Yeah. But it's an interesting accounting question as to why it's not run through financials.
we'd certainly like it to be, and then we can collect it.
But you're going to come up with that number, right, next year? Aren't you coming up with that number?
Sorry?
Aren't you getting the carried interest costs for the peers?
We're trying. We actually asked an optional question on the survey to give us the detailed private equity, and a number of funds do that. In fact, we're up to about 60 funds of the 200, of the 300 or so, who are giving us their detail, their carry. We're looking at, Larry and I have had this discussion, I call it rebates or transaction costs that can be embedded in some of that stuff as well. That adds another layer. We're certainly encouraging and trying to get that information as best we can. All 20 of us, if I make the point. It's very hard dealing with funds all around the world to get that. And accounting standards don't favor us all the time. So
if I'm hearing what was just said by the three of you, is that the costs on page 31 under external active management for real estate private equity is much higher than this number.
Magnitude.
But in private equity, our peers, U.S. peers, have gone further internally managing real estate, because that seems to be an easier thing to get your arms around than buying whole businesses. You might comment on that.
I would agree. I think what I took, the second part that I took from what Larry said, and I think I got it right, is that there may not be an option to take in the U.S. currently private equity internal active. as the Canadian funds do. But in real estate, there are funds. New York Teachers is an example of one where, in fact, there is some internal real estate that is managed, and there are other funds that do that. So whether you want to or not is a different question, but there may be opportunities there that there may not be in private equity to the same degree.
And Al, I'm going to go out and say that we go from 8% to 20+% in the gas. This is a huge issue. And quite honestly, it's a governance issue as much as it is this issue about fees. Sorry, you wanted to go back to the Richard Fast question.
I was actually just going to push through and we'll answer it if I can continue with the presentation. On page 23, very quickly, what we're doing is bringing together each fund benchmarked against its peer group, that excess cost number, and we're plotting that against the net value added that they've got. So in other words, if we take the asset allocation out for each fund and look at what they're getting in terms of value added after costs, that's the plot. So obviously the top left-hand corner, if you were one of those funds, you would be getting high value added after costs, and you would be spending less than we would expect a fund of that size to spend. If you're bottom right-hand corner, you're spending more than we would expect a fund of your size, of that size to spend, and you would have less value added. The red dot in the middle is where New York retirement systems are at this time. In terms of pattern, it always looks like this. Doesn't matter what country, how we do it. It does not have you're spending more, therefore you're getting more feel to it. It always has sort of a scattergun approach. Just pushing on, I did mention earlier that I would show you a chart showing that all costs in the U.S. have increased on page 24. There is that chart. You can see that they've gone from 35 basis points in 2001 to 61 basis points in 2010, primarily because of a move to more expensive assets. People are not paying more for public equities in 2010 than they were in 2001. This is about asset allocation and turns to reinforces the discussion we just had. On page 25, we're just looking at external active management, and it's actually increased from 65 to 73% over the last 10 years. So just some numbers there on for 10-year analysis rather than the 5 that we looked at before. And I'm sorry, I'm kind of skipping through some of this to get to the question before. And then on page 26, we're looking at real estate, private equity, hedge funds. So this is more just to take away and have a look at, if you like, just some trends over time. What are funds in the U.S. doing, and what's the trend?
So, page 25. So it looks like the management is trending away from the government?
The answer behind that is multifaceted, but the real reason...
If you look at page 25, it appears that the trends it's trending towards external management and away from past internal management.
What may be happening there, and I can infer it from a multitude of other charts, is that as people are moving to, as funds, and this is all funds, not the peer group, are moving to alternative assets, they are moving to external active management. To your point exactly in the discussion we just had. So as they're moving into hedge funds and private equity, they're not doing that internally. Less people do that. The large funds do that. Medium-sized funds tend not to, and small funds tend not. A small fund will not manage a private equity asset class internally. It may manage cash and bonds.
So, and the reason funds are trending towards alternative asset classes Is the perception that they're going to get more money for their buck?
Let me put that in terms of risk return. Yes. It's not a total return game, it's a net return game given an established risk profile. So each fund is making that.
You're saying it's not working well?
We're showing that scatter plot shows you to make a darn difference in zero sum. The fact that it's a scatter no matter if you say what.
Well, there's a lot of inference in that comment. If you look at value added, if you invest in the US equity market, there are probably 2 or 3 benchmarks that you'll use to measure that. If you look at the private equity world, there's a range of custom benchmarks that are used. And if we're looking at value added, it is actual return less benchmark return. So one of the issues in measuring value added, just as a word of caution in drawing conclusions there, is that the industry doesn't have a standard on alternative assets. Real estate, not too bad. Private equity, according to our database, not really at all. Hedge funds, similar. So you'd need to do some to come up with that statement. Someone would need to do some analysis around standardizing a benchmark and then looking at the value added there.
So the number you use is a self-reported number.
Self-reported number.
Arguably they're at least adjusting for the risk they are willing to take.
In some cases. I'd like to draw your attention to page 27 now. As I mentioned, we have 20 years of data. We're looking here at data from 1991 to 2009. And we've run some regression analysis to come up with some findings. And the findings are summarized on page 27. I'll give you a little more detail on some of these. We're looking at the characteristics of the best performing funds, those who are getting higher net value added. Things that didn't matter when we ran a regression was corporate versus public. We couldn't find out. One does better than the other. The number of external managers, having a lot of external managers as opposed to having a reasonable number, that didn't seem to matter either. What we did find over this period was that large funds did better. And we're going to look at that number. The lower the total cost, the better the net value added, which makes sense because we're taking the value added number, in other words, how you performed against your benchmarks or your policy, and then taking your costs away from that. So if you minimize those costs and take them away, obviously it's going to look better. In terms of asset mix, during this period, and I must stress that, US small cap holdings and private equity holdings outperformed their benchmarks. And then implementation style, internal management did better. Now, I think there's some interesting points there if we can turn the page and look at some of them in a little more detail, not too much, but there's detail for your reference later if you want to read through it. Large funds did better than small funds. The T-stats are there and the reasons are there. The top left-hand paragraph kind of sums it up nicely. For every 10-fold increase in size, net value added increased 15 basis points. And it's probably not linear. However, for the period, for the funds that we looked at, the difference between a 1 billion fund and a 100 million fund is 15 basis points in net value added. So value added after costs. The primary reasons behind that was investing in private equity during the right period, US small cap during the right period, and minimizing total cost. So where large funds did better than small funds was that the value-added piece was largely accounted for by private equity and small cap stock, if you had allocation of those, but also what you take away in terms of cost. If you minimize your cost, and large funds could do that, your value-added is better.
You said U.S. small cap at the right time. What did you mean by that?
It's not a linear value added. If you look at US small cap markets over the period that we're looking at, 91, so it's almost 20 years of data, if there's an equity person here to comment on that, US small cap outperformed quite a bit. So did private equity. If you got in at the right time, some funds did very well getting into private equity at the right time.
In effect, are you saying that a couple of the items on page 27 are historical and not necessarily predictive?
That's absolutely correct, and thank you for pointing that out. The old past performance should never be used, yes. The next page 29, funds with more internal management did better. Now, through our Global Leaders Program and some research on this, we've not been able to point to large funds with external markets or internal operations saying they definitely did better in terms of getting gross return. However, running the regression, what we can look at is internal management doing better once we take the costs away and bring it to net value added. Because internal management overall, and we've looked at the numbers at the back, internal management overall is less expensive, therefore the net value added comes in at a higher number.
You have found that the internal managers have in fact been able to produce similar returns to external managers,
Therefore, the cost difference benefits. I'm sorry. Does this mean that the internal managers have produced similar returns to external managers and the benefit therefore is lesser cost? Or can you not make that statement from the data?
I think there would be a distribution of internal management as there is a distribution of external management in terms of gross returns. What we find is when we look at the cost of internal management is definitely, as per the database, less expensive than external management. So the cost of internal management is less expensive than external. So when you take, a distribution of returns, gross returns, and a distribution of gross returns for internal and external, but take different cost numbers into account, the internal management does better.
Well, if you just take nearly 600 basis points, the required IRR on a deal is much lower because you have that much room to play with. You don't need to, knock the socks out deals if you have a 600 basis point cost advantage.
I'm not suggesting that's not the case.
I
am suggesting, however, that the bottom line to all of this is whatever active management you choose, internal or external, has to earn its keep. And internal management based on these statistics suggests that you get a heads up, you get a starting benefit, but in the end, if you can't deliver it internally for the advantage you have versus external, you shouldn't go down that road.
But the threshold returns for that internal are just a lot lower. You have a lot of room to play with to still come out ahead of external.
On some asset classes.
I mean, the key is in the execution, right? So cost is interesting, but if you get the wrong people, you lose a lot of money. If you get the right people, you make a lot of money. In both cases. So they all go bell curve. You can't presume that the outside managers are smarter than the inside managers, everything else being equal. But to Raj's point, you can't assume that if it was all the same, if you paid less, you make more. But you can't assume that it's all the same.
That's right.
Right, so it really is very hard to sort of work your way into external, and it is not a flip a switch on. It's I look at Canadians, it's a 20-year progression when you start somewhere, you slowly build some teams, you fire people, you get systems. I mean, it's a big thing to go from 100% external to 50% internal. But you gotta, there is a sort of, there are building blocks, to Ranji's points there, some asset classes that are easier to enter than others, and then there's what I call the PhD class, which is by a company environment. Right. That one has to be a PhD to move into internal management.
And that's the only way to get that 600 basis points back, is if you're doing what Blackstone does.
Oh, but each asset class.
You're buying the company.
Well, that's not right, Al. Each asset class had savings on his chart. Every asset class, if you look at internal versus external, it's the same money. the cost, then you have to make sure you're executing the sale. So you can't just assume away execution.
Well, there was, in fact, coming up on the next page, one asset class that appears, at least because of the city's fine negotiating skills, to do better with external management, and that is the external passive large cap or large U.S.
That
equities.
number is like unreal. Nicely done.
Just to draw your attention to that, the number they're talking about is on page 31. And it's the top line on page 31, the U.S. stock broad, which we looked at in the analysis as we went through. And the reported number from New York Retirement Systems for that large amount of investment in external passive is 0.3 basis points. If you look at the peer median on the right-hand side, the internal passive, where they've taken it internally, hired someone to run it passively, is 1.9. And the external is 0.8. So there's an argument for large allocations to passive and negotiation versus setting up internally, absolutely. That would be the only asset class.
Although it looks like the E from
All the equity passive.
as well as our inflation index.
Oh, well, that's, yeah.
This is an impressive bunch of negotiators now.
We have a special room in Iraq. Contact
Well done.
The last page, just to finish on then, is just another slice and dice of the data, I guess. We put funds into two groups. They were either low cost, middle cost, or high cost. We left the middle cost out and just looked at low cost funds against high cost funds, and then just took a look at their net value added on page 30.
What page you on?
30, sorry. And so this is just a random bucket looking at, okay, let's take the top group of high-cost funds and the lowest funds out there and see what the difference is. And the effect on net value added is quite dramatic. You can see that looking at the bottom of the graph, net value added from the high-cost funds was negative, and net value added from the low-cost funds was 23 basis points. And again, if you look at the low-cost funds, a lot of those are large funds doing it internal. So it's just reinforcing the point again, I guess.
Are you done, Mark? Are you done?
Yes.
I had a question. This is either for you, Dan, or Larry. These numbers make me damn dizzy. And I'm a union side labor lawyer. I'm a workers lawyer. At the end of the day, I want to know, what does this mean? Like, what are the practical steps that this means for BAM, us? What are the recommendations from us? What's the roadmap? What does it mean? What do we do?
Well, maybe I'll take a shot at it. So there was a question a few months ago as to how do our costs look? So this is partly an answer to a question, and it's partly an answer to a question that BAM had, which is, if we look at our peers, are we set up to do battle to make the most money for the pensioner? And when you look at it, and we have lots of information by fund, we're in the distinct minority how we're set up. Okay? We're set up as a business to be a low-cost provider on a 100% outsourced business model. Okay? We're over here. The people that have pushed the model the most, the Canadians, are 70 to 80% insourced, pay their people extremely well, and have higher rates of return than we do. So you look at those two bookends, and you say, what do we think of that? So first we said, well, let's get an outsider to look at our cost structure, and you end up, your costs, if you just look at the aggregate number, are in the middle. However, there's two pieces to it. One is implementation, which is internal versus external, and the other is just negotiating. So we're good negotiators, but then you're still back to, do we need to look at our business model? Which is where BAM was coming from, because again, it's all about net return. And I would tell you that we're not set up right for this millennium, let alone this decade. And at some point, and hopefully in the future, to your question, we should think about and discuss different ways to set the place up. But it's not easy, and it's not a one-meeting thing, and it's building a different mousetrap than we have today. And again, there are different models by asset class, by governance structure. New York State Teachers does it one way, New York Common does another, CalPERS does it one way, CalSTRS does it another. And what we wanted to slowly engage the boards in is, let's take a step back. We're long-term investors. Do we need to build the mousetrap differently so that we can continue to try to get the best net returns? So this is part of that conversation.
And Larry, if I may, as part of that conversation is also the 5 funds acting together pretty much.
Yeah.
Because what we decide is not, not enough.
Well, we have to get everybody to agree.
Right.
We're not everybody have to figure this out. But again, if you look on a piece of paper, our model is over here, the best in class is over here. There's lots of answers in the middle.
Right.
Let's look at it, put it all on the table, and decide if we want to change the model, which is going to take a long time. All 5 funds.
The direction of our piece is also only upward relative to our peer group. That's the other takeaway that we should not lose sight of.
But with reason, right? It's not just fees. There was a reason we went from 9% alternative to 20, right? But we all agreed on that reason. And you're right, the costs are going to go up because you're going from basically passive index up to 1.5 and 20. That's happening. We're all agreed to implement that. So the costs are going to go up. Hopefully it goes back to provide value, so our net return goes up as well, less volatility, all that good stuff with the asset allocation. But this is different ways to do this, because at the end of the day, your basic question, this is an asset management business.
And I'm not going to have asset manager. My question is, and I'm not going to asset manager. I guess is my point. I guess at some point, I'm new to this, and I'm sorry to folks that have it, but it seems to me at some point the experts are, and I mean beyond the politics of it all, whose office is managing what and all that type of stuff that I've been hearing on the phone. But how do we get to a point where we make this the most nimble, effective pension fund that we can with real, I'm not skilled enough to participate in this discussion, quite frankly. I mean, I can understand it, but I can't make a decision about it. It seems like experts ought to be able to come to us with specific, risk their reputation recommendations about why this is the best way to go forward. Let's look at it and check the mechanisms, the metrics, how they got to that, as trustees, but then vote on and keep it moving. Is my thoughts.
So Larry, will you be back to us with specific recommendations?
We'll be back in September with more information. Right, because I can't do it in vacuum. We'll come back with, here's a bunch of different ways to look at it. It's complicated. You need experts. You need outside experts to help us. So someone has to pay for that. Because again, we don't have a budget to hire outside experts to help us. But I'd like to come back to you with a menu of items and say, let's focus on this menu. Again, we're not going to start with the PhD level of buying businesses, but there's some easy, what I would call, there's some very low-hanging fruit that we've been working on.
That might not be a good one to use.
And then there's steps.
Someone had a phone call this week about low-hanging fruit.
I must have missed that.
Yeah. All right, I'm going to be quiet and listen to you.
Wait, any other questions for Alan?
No, but I just wanted to respond to what Larry said. And what I imagine, one of the things you're going to come back to us with, Larry, is the degree of resources we're going to need to execute anything that you're suggesting, and more specific details of how to deal with what my time on this board seems to have been kind of a stumbling block to executing any of these kind of ideas, and that's our ability to compete in the marketplace for talent.
That's up to the board to decide. If the board wants to compete, they have to go bottom.
Okay, but we need to know what we have to do to compete.
Pay all
So-
tax.
Gotta pay you, I guess.
That's one.
And the other thing I would say is that this is, I think this is great timing because we are, in an ongoing review and what I believe is going to be coming up with very significant changes to our governance structure. So
This is ultimately all about governance.
right. So this is good.
All converging. Thank you very much, Alan.
Thank you.
And Catherine.
Thank you.
Okay. Next item on the agenda is a request from Al Rodriguez to talk about the innovative procurement process that's underway. Give us 1 second to get Tony Delolio. There's Tony. You all know Tony Delolio? Yeah, of course. Okay. So I'll hand it over to you, Al.
Okay. So,
I'm sorry, I got this.
okay, we're going to wait for Ken to...
Take breaks.
Madam Chair, is it all right for us to have a 5-minute break while...
Take breaks.